It is 3:47 in the morning. You are lying awake, staring at the ceiling, and you already know why. Your hand is reaching for the phone on the nightstand before your eyes are even fully open. The screen glows blue, casting a cold light across the room. You thumb into your banking app. You watch that little loading wheel spin for half a half second that feels like an hour. And then you see the number. The number is exactly what you thought it would be, because you also checked it at 11:42 last night, and 9:15 in the evening, and during your lunch break. You haven't moved a single dollar today, but you needed to make sure the dollars hadn't moved either. Now, imagine a different person, same age as you, same city, maybe even the same job. This person hasn't opened their banking app in 3 weeks. They couldn't tell you their checking balance within a $1,000 margin if their life depended on it. They sleep through the night like it is a constitutional right. What is the difference between these two lives? It is not genius. It is not a trust fund. It is a specific, numerical threshold that changes the very physics of your financial existence. Most financial gurus will tell you that you need $1 million to be free. They will tell you that 6 figures is the magic milestone. They are wrong. The evidence points to a much smaller, much more dangerous number. Dangerous, at least, for the institutions that profit from your stress. That number is $20,000. Today, we are looking at why hitting $20,000 in liquid cash triggers a silent alarm inside your bank's headquarters. We are going to reveal the mechanisms they use to keep you from ever reaching that line, and I'm going to show you exactly how the power dynamic flips the second you cross it. If you feel like you are running on a treadmill that is moving slightly faster than you can keep up with, pay attention. Because the bank is not just your partner, they are the toll road operator. And $20,000 is the moment you build your own bridge. Let us be real for a second. We have been told our whole lives that the bank is our friend. You save, they are happy. You hit a milestone, they send you a nice little congratulatory email. But that is the marketing language. The internal language is very different. I talked to a former branch manager, let us call him Derek, who worked at a major regional bank for 15 years. He told me that they tracked customers by something called contribution margin. And the highest margin customers? They were almost never the ones with the most money. They were the ones with just enough money to keep needing the bank. The ideal customer for a retail bank earns between $50,000 and $80,000 a year. They carry a small credit card balance. They occasionally overdraft. They have an outstanding auto loan. And here is the kicker. They consistently stay under $20,000 in liquid savings. To a bank, a person with 20 grand in cash is a stagnant asset. You are essentially a landlord who is not charging rent. But it is deeper than that. At 20,000, you stop being a source of revenue, and you start being a risk to their profit margins. Why? Because $20,000 is escape velocity. Below $20,000, you are reactive. You take what you can get. You cannot negotiate your salary because you need the next paycheck to cover rent. You cannot shop around for better insurance because you are one check engine light away from a crisis. You are captive. But once that balance hits 20,000, your brain chemistry literally changes. And this is not just mindset talk. There is a famous paper published in the journal Science that measured the cognitive impact of financial stress. The researchers found that chronic financial anxiety, the kind you feel when your balance is low, actually impairs your performance by 13 IQ points. 13 points. That is more than a full night of sleep deprivation. When you are broke, you are literally operating with a smaller brain. You make impulsive purchases because your brain is starving for a dopamine hit to offset the stress of scarcity. You accept terrible deal terms because you do not have the bandwidth to compare options. The banking system does not just make you poor, it makes you worse at getting out of being poor. But at $20,000, those 13 IQ points come back. Suddenly, you have the clarity to look at a 24% annual percentage rate credit card and realize it is a heist. You have the patience to wait for a better job offer. You have the leverage to tell your landlord that you will not accept a rent hike without a fight. The bank fears this version of you. They want you in high engagement mode, which is corporate speak for the people we charge the most. Let us look at the first layer of the trap, the overdraft economy. In 2022, United States banks collected nearly $8 billion in overdraft and non-sufficient funds fees. $8 billion. But here is the stat that should make you angry. 9% of account holders paid 79% of those fees. The bank is not casting a wide net. They are targeting a specific demographic at a specific financial stress level with surgical precision. They use transaction ordering algorithms. If you have 5 pending transactions and your account goes negative, many banks will process the largest transaction first. Why? To make sure your balance drops to zero immediately, so they can charge you a $35 fee on every single one of the smaller items that follow. They call it overdraft protection. They marketed it as a service, a safety net, so you would not be embarrassed at the grocery store. In reality, they converted a declined transaction, which costs you nothing, into a $35 profit event for them. But the fees are just the beginning. The real war is being fought over your inertia. Most people keep their money in a standard savings account at a big-name bank. In 2026, these accounts pay an average interest rate of about 0.05%. On $20,000, that is $10 a year. A single lunch at a fast food joint. Meanwhile, that same bank is lending your $20,000 to your neighbor at 7% for an auto loan, or 22% on a credit card. They are capturing a massive spread on your hard-earned capital. They rely on your financial inertia, the fact that you are too tired, too stressed, or too busy to move your money to a high-yield account or a treasury bill that pays 5%. The inertia tax on $20,000 is roughly $1,000 a year. That is money you are voluntarily donating to the bank's dividend pool just because you haven't built your own bridge yet. Once you hit the threshold, the math of inertia becomes too loud to ignore. $100 a month in lost interest is a car payment. It is a family vacation. It is real. And once a customer becomes yield sensitive, the bank knows they have lost control. To understand how this looks in the real world, we need to look at 2 subjects. Let us call them David and Priya. David is 36. He works in logistics management in Atlanta, pulling in $71,000 a year. By every standard American metric, David is doing fine. He has never been evicted, his credit score is in the high 600s, and he has a steady paycheck. But David has a secret. He only has $2,400 in his savings account. That is his entire shield between his current life and total chaos. David does not feel like he is in danger every day, but his bank? His bank loves David. To them, he is the perfect customer. Last year, David paid $487 in overdraft fees because he miscalculated the timing of a subscription. He paid $228 in maintenance fees because his balance dipped too low. When his car broke down and he needed $1,800 for a repair, he did not have it, so he used the shop's easy financing. That easy money cost him an extra $340 in interest over 6 months. Add it all up, and David paid over $3,100 last year in what I call the Desperation Premium. That is $3,000 gone, not because he made bad decisions, but because he was in a weak negotiating position. And in the financial system, institutions can smell weakness from a mile away. Now, look at Priya. She is 33, a nurse in Phoenix, and she actually earns less than David, about $67,000 a year. 3 years ago, she was exactly where David is, but she decided to run a different experiment. She became obsessed with hitting one number, $20,000. It took her 26 months of unsexy, boring discipline. She picked up extra shifts, cooked every meal, and told her friends she was on a financial cleanse. And then, she hit it. $20,000 sitting in cash. Immediately, the physics of her life shifted. When Priya's car needed the exact same $2,100 repair that David's did, she did not ask about financing. She told the mechanic she would pay cash. The mechanic, without her even asking, offered her a 12% discount because cash today is worth more to his business than a debt contract. That one moment saved her $252, while David was paying $340 extra. But the real kicker happened at work. Priya's management changed and they started making her life a nightmare, trying to force her into a schedule that did not work for her family. Old Priya with $2,400 would have had to smile and take the abuse because losing her job meant losing her house in 3 weeks. New Priya had what we call the walk-away position. She did not have to be aggressive. She just sat in the meeting and calmly said, "This does not work for me, and if we cannot find a solution, I am prepared to resign." When you have $20,000, you do not just say you are willing to walk. The people across the table can feel it. It is a vibe, a posture, a lack of sweat on your palms. They worked it out. They gave her the schedule she wanted. Why? Because she had options, and options are the only currency that truly matters in a negotiation. Here is something the banks really do not want you to know. The industry actually has a specific name for people like Priya. People who pay their bills on time, keep a high balance, and never pay a cent in interest or fees. They call them deadbeats. I am not making that up. It appears in trade publications and internal documents. If you are a transactor, someone who uses the credit card for the points but pays it off every single month, you are a deadbeat to the bank's bottom line because you are not profitable. The customers they prize are the revolvers, the people who carry a balance and pay 24% interest every month. They want you to be a revolver. They design the apps to make it easy to pay the minimum amount but hide the Pay in Full button. Our goal is to help you earn your deadbeat badge as fast as possible. Because $20,000 is the point where you stop being the prey and start being the predator. Now we have to address the most expensive part of the banking model, something that has nothing to do with numbers on a screen and everything to do with the biology of your brain. In the academic world, they call it the scarcity mindset. But in reality, it is a functional tax on your intelligence. There was a landmark study from researchers at Harvard and Princeton that proved that being under intense financial pressure, the kind you feel when you have less than $2,000 in the bank, actually drops your functional intelligence by 13 IQ points. Think about that. 13 points. That is the difference between being a high performer and being average. It is the equivalent of trying to navigate your life while being legally sleep-deprived. When you are broke, your brain is so busy calculating the cost of groceries and the timing of the electricity bill that it has no bandwidth left for long-term strategy. You make impulsive decisions because your brain is starving for a dopamine hit to offset the stress of scarcity. You accept terrible loan terms because you do not have the mental energy to compare 5 different options. The banking system does not just profit from your lack of money, it profits from the biological fog that comes with it. But when you hit $20,000, that fog lifts. Suddenly, you have your 13 IQ points back. You have the clarity to look at a credit card offer and realize it is a trap. You have the patience to wait for a better car deal. You have the power to say no. This brings us to a concept in behavioral economics called the outside option value. To understand this, look at Claire. Claire worked in marketing for 8 years under a manager who took credit for her ideas and blocked her promotions. She stayed because she had $6,000 in savings and a mortgage. Her manager knew she could not afford to quit. Then, Claire inherited $18,000, bringing her total to $24,000. Within 90 days, she applied for 3 new jobs, received 2 offers, and resigned. Her old company suddenly offered her a 23% raise to stay. She did not get smarter. She did not get a new degree. She just became non-desperate. Non-desperation is worth roughly 20% of your annual salary in any negotiation. If you are being underpaid, it is probably not because you lack skills. It is because your bank account does not give you the leverage to walk away. So, how do we actually reach this threshold? We follow a 4-step protocol designed to hack the physics of the banking system. Step 1. Calculate your monthly baseline. Most people track what they want to spend. We track what you need to survive. Add up your rent, basic food, transportation, and utilities. No streaming services, no gym memberships, no Friday night drinks. This is your survival number. For most Americans, this number is around $2,200. Know this number. It is the size of the gap you are trying to bridge. Step 2. Engineer friction. Human behavior follows the path of least resistance. If your savings are 1 tap away in your main banking app, you will spend them. To beat the bank, you must open a high-yield savings account at a completely different institution. Different app, different login. You want to make it slightly inconvenient to move that money. Friction is your friend when it comes to discipline. Step 3. The Choken automation. In Japanese financial culture, there is a habit called Choken, which means saving first and spending what remains. This is the inverse of the American model. Set up an automatic transfer the morning your paycheck hits. Treat your $20,000 cushion like a high-priority bill that must be paid before you buy a single coffee. If you do not see the money, your brain will adapt to the remaining balance within 60 days. Step 4. Protect the firewall. This is where most people fail. They hit $8,000 and suddenly a vacation deal or a wedding invitation comes up. You must define a true emergency in advance. A car repair that allows you to get to work is an emergency. A friend's destination wedding is a social event. Protect the cushion ruthlessly until you hit the mark. Once you reach that $20,000 mark, the constant low-grade hum of financial anxiety just stops. You stop checking the app at 3 in the morning. You become a deadbeat to their profit model and a scientist of your own freedom. The system was built to profit from your motion, your borrowing, and your desperation. By sitting still, by being disciplined, and by holding that bridge, you officially opt out of the predatory side of the economy. You are not just saving cash. You are reclaiming your time, your intelligence, and your right to say no. Welcome to the other side of the threshold. The toll road is still out there, waiting for the next captive traveler. But you have built your own bridge. You have crossed it, and you never have to pay the toll again. If this experiment changed how you see your bank account, hit that subscribe button. We are breaking down the systems they hope you never understand. I will see you in the next one.